Yo, what is going on, everybody? It's your boy Jerry Trades back with another banger video. And on today's video, I'm gonna go ahead and summarize exactly how to get into long-term investing as a beginner. Over the course of this year, I've had a lot of inquiries, a lot of individuals reach out to me saying, Jerry, I want to start investing. I want to start making my money work for me. How do I get into it? So today I'm gonna go ahead and be showing you guys how to start investing your first dollars, how to allocate them, how to diversify a portfolio in between low risk, medium risk, and high risk assets, and how to navigate the market to find up and coming valuable companies, and how to already invest in some of the biggest names that we know in the market. So when you're first getting into investing, I hope you guys already watched my personal finance videos, as they are very important to understanding what it is you have in disposable income. It's very important you know that you cannot afford to invest which you can't afford to lose. So if you begin investing money that you need to pay bills with or take care of certain life crucial expenses, you're never going to be able to actually be comfortable with your investment, and later on in the short term might want to sell or use that capital for other things. So understand this is a contribution for the long term. This is essentially a savings account that you're doing your best not to touch, protect until the years that maybe you're 40, 50, 60, looking now to retire, and you've accumulated a pretty decent amount of wealth for yourself. While you're young, it's very important you start developing your asset column. Assets are things that you buy with money now that increase in value later. A lot of individuals, especially being so young, I heard now in my local environment and network, I have buddies that got into gambling, buddies that got into sports betting, and they didn't really get too far. So it's important that you start developing better habits. Even if you're a girl and you're not participating in all that, there's so many irresponsible and negative financial habits that people participate in that set them back over the long term. And it's important that you start building some sort of a discipline and contributing to your long term financial health and stability. So using the stock market's a great tool, but not a lot of people know how to navigate it. So today I'm gonna go ahead and teach you guys how to start perceiving it and understanding it. So an example that I like to share with all of my clients is back in the gold rush. Everyone knows this big American event where people flock to California to start looking for gold. Well, back in the gold rush, there's individuals that made money looking for gold, and they made money selling the shovels. Many individuals made some money finding the gold, but whoever sold the shovels always made more. So let me go ahead and add a little bit more context to this example. In the gold rush, who do you think made more money? The people looking for gold or the people selling the shovels? Well, I hope that you are able to put together that the person selling the shovels made more money. And why? They made more money because in order to look for gold, you're not going to find it with your hands. You need to use shovels, pickaxes, and other tools. So the individuals selling the tools are the ones who walked away with the most money, because the ones looking for gold were just taking a gamble, trying to find that huge return in the short term. So picking something secure is always going to be where you want to pivot majority of your portfolio and your capital towards your investment strategy. So keeping it safe by buying shovels, things that are essentials, big companies, ETFs. These are assets that we know if we ask ourselves, hey, is Elon Musk, is Jeff Bezos, is Mark Zuckerberg, are any of these CEOs going to go out of business in the next 2 to 3 years? Answer is probably no. I think we could both agree on that. So understanding it through that lens, investing for the long term, investing in the quality of, the company, the innovation, what it is it's offering to the industry or the economy or the world. That's how you want to start pivoting your vision as an investor for the long term, never for the short term. So how do I start diversifying myself into different assets? Well, aside from the low and medium risk, you have high risk companies as well. High risk companies are companies that aren't as well established, that aren't as big, aren't as well known, but have a lot of innovation, have big business plans, and high expectations from investors to slowly grow into new and upcoming companies. This is kind of like investing in Apple back in the early 2000s when you had the BlackBerry or flip phones from Metro PCS. When someone would have told you, hey, buy Apple stock, soon they're going to make a device like the iPhone that's going to change the world forever and how we use cellular devices, some people must have called them crazy. But look at now, this is the number one phone cellular device across the entire world. So these are the gold, the opportunities that don't really are well known, aren't as popular, but they're set. They have opportunity, they have innovation, and they have leaders to help change the world. So understanding now this perspective, right? Buying shovels and gold, You want to learn how to diversify yourself with low risk and medium risk to keep a strong, steady, slow growth to the portfolio, while then exposing yourself to high risk at just a minimal percentage, so you're building something secure and steady, but also risking about 40% of that disposable investing income for higher gains, higher potential growth in these unestablished, not as popular companies, but soon can possibly change the world. So, how I like to highlight this to help people navigate this is understanding how to diversify between low risk and medium risk assets. So, I kind of give this example to all of my clients. When you're investing in the stock market, if you're a guy, some girls might understand this example, but in the NBA, just going to use a sports team here, you have a league, right? So that's a sports league, basketball, National Basketball Association. The NBA in this example represents the stock market. Now, that's the entire market. In this NBA, we have teams, and the teams, they have all stars and good players. Now, let's take it just a step back. When you're looking at this through that lens, you have to understand that the teams represent sectors. Sectors are parts of the stock market that represent different industries. So if I go ahead and bring up the TradingView heat map, you guys are going to be able to see the different sectors. So let me go ahead and fix this real quick. These are all the different sectors that we have in the stock market. Of course, there's many. Just going to have a little bit of trouble fitting this here. Perfect. So these are some of the few sectors that you have in the stock market. My face is covering them. There you go. So these are some of the few sectors that you have in the stock market. You have retail trade, health technology, utilities, energy minerals, transportation, health services, industrial services, distribution, communications, commercial services, and so forth. You can see that we have a lot. So the NBA, in this case the stock market, is everything combined. Now the teams in the league are these sectors. And in these sectors, you see there's quadrants that are bigger than others. The reason that these quadrants are bigger than others is because these are considered the all-star players. The biggest, baddest players in the team are always going to have the bigger quadrants and have more dominance in that industry or that sector of the market. So now jumping back to the example of low risk and medium risk, understanding that when you're investing in the stock market, you're always going to look to acquire these all stars as independent companies, and that's what we're going to call medium risk. And then exposing yourself to low risk investing using something that we know as ETFs. For those of you guys that don't know what an ETF is, you can kind of perceive it as a combination of all of these all stars in every single industry, all playing for one team. So when you have this understanding, it's like I'm buying a team full of the best players in all of the industries. And this is an example of an ETF right here. One of the most popular ETFs known to the United States and many Americans beginning to invest is called the S&P 500. The S&P 500 is an ETF, which is, just to define it for you guys, it's a portfolio of multiple companies and all diversified in between different sectors. The S&P 500, you can see here, is a 35% technology, 13% financial services, 10% communication services, and so forth. It's diversified into these sectors and is diversified into all of these companies. These are just the top 10 holdings, but there's about 490 other companies that are in the S&P 500 that help build this strong upward trajectory. Now, these are the top performing companies. So what happens when you put all the top performing companies? You usually have steady upwards growth. And this is a reflection of a portfolio that's strategically diversified and also put into a lot of these all-stars and taking less risk in, unestablished or unpopular, or you would say high-risk companies, limiting that risk and sticking to more, established, built, well-known companies that are providing high revenue, high earnings per share, high investor interest. That's how you start building your portfolio to now maybe mimic the growth of the S&P 500. So this is how a lot of investors build kind of a base goal. They look at the S&P 500 as like a baseline. Why? Because the S&P 500, for those of you guys that don't know, it has been known throughout centuries to provide a minimum of a 10% return year over year. So this year, if you go ahead and look at it, the S&P 500 has a yearly return of 16.24%, which is phenomenal. We outperformed the minimum by 6%. So now that you understand that the growth is minimum 10%, this is how you start allocating about 60%, maybe 30%, 40% of your portfolio into this ETF. Why? Because you know that this is the baseline. This is a way for me to secure long-term growth without exposing myself to too much risk, especially if you're a beginner that doesn't know a lot of these companies. Maybe you're not familiar with Nvidia. Maybe you're not familiar with Broadcom. Maybe you're not familiar with Berkshire Hathaway. Maybe you just know companies like Apple and Nike, and that's some of the few names you know. But if you're more experienced, then it's going to be a little bit of a different scenario for you. But now, if you're just getting into the market, putting maybe $40 a week, $100 a week, contributing little by little to the S&P 500 is a great way to get started with investing and not being too worried about it going up, going down, and you losing money. You have something that has proven track record, and in the next theoretically 30, 40 years, it can gain this consistent 10%, assuming we don't have any huge financial crisis. So the ETFs and the S&P, there's other examples that I shared here on the pie chart. VU, QQQ are all very well established ETFs that many Americans, insurance companies, 401k plans use to build steady growth for all of their customers or investors. Now, understanding medium risk. Well, medium risk only is it called medium risk because instead of buying an all-star team of all of these companies combined into one portfolio, you're just going to invest into each one individually. So a company like Tesla. Well, if we go ahead and look at Tesla's growth here for the year, let me go ahead and bring that up real quick. And then bring this back over here. All right, if we look at return on Tesla, look at, okay, not that much higher, right? It's about 17% on the year. That's slightly higher than the S&P 500, but the reason this is considered medium risk now is because it's only one company. So if majority of your portfolio is put into Tesla and Tesla begins to trend downward, there goes your portfolio with it, compared to putting some into the ETF, maybe majority into the ETF, and then some into Tesla. Now, Tesla can be going down, but the ETFs could be going up, therefore offsetting the losses and keeping it more steady growth. And that's called diversification. Not putting all your eggs in one basket. So if one goes down, you're going down with it. But maybe putting 50-50 or 40-40 into medium risk and low risk. Low risk being ETFs, medium risk being these individual companies. Why do people even acquire medium risk? Well, maybe Tesla wasn't the best example, but if we look at a company like Nvidia, now you have a 38% in a year return. That's phenomenal. That's about maybe double what the S&P 500 did. Now, these are why you invest in medium risk, because you want to be able to take advantage of the increased potential growth, but also plan some sort of security by allocating maybe a majority if you're a beginner or some of your portfolio towards keeping it slow and steady in these ETFs. Another great example that I like to highlight is Broadcom. Broadcom year-to-date return is 48% return. That's almost triple what the S&P 500 has done. Now you're understanding, okay, I want more growth out of my portfolio. I want to expose myself to some of these companies that have this potential growth that are in the S&P 500, but I'm going to invest in them individually for more returns. So now you're combining low risk security and medium risk for more potential growth. So now that you understand individual companies, another great one that I like to highlight and share with you guys is AMD. Look at that, 76, almost 77% year-to-date return, which is phenomenal. You outperform the S&P 500 by 7 times. The S&P 500 only does 10% in a year. Anything above 10% is a blessing. It's an achievement. It's a phenomenal ability to be able to outperform the S&P 500, as many top-performing hedge funds and institutions struggle to outperform the S&P 500 on a year-to-year basis. So now that you guys understand low risk and medium risk, the next series of companies that you would be investing in are called high risk. High risk companies, don't necessarily have this minimum of 5 years in business left in them. These are companies that you're taking a risk on, that you're not as secure and reassured by. These are companies that are developing, looking for investors, looking to innovate and change the world, but haven't gotten that mainstream attention that they deserve. Big companies that have partnerships maybe with these bigger companies, more established companies, but hey, they might take the next 3 years to just build themselves up. Like I say, this example, minimum 5 years of business, high demand industries are companies like Tesla, AMD, Nvidia, Amazon, Meta. If I ask you, are these companies going out of business in the next 2 to 3 years? You're probably going to say no. These are low risk and medium risk because you have that reassurance that these companies aren't going to go out of business compared to now high risk. So to kind of show you guys the returns that you have with a high risk, let's go ahead and bring up a really big company that I'm a fan of called CoreWeave. CoreWeave year-to-date return is 82%. That's phenomenal, but not everyone knows CoreWeave. If you go and tell your neighbor, your parents, hey, have you heard of CoreWeave? More than likely, they're going to tell you no. And that's because this company isn't as well established, isn't as, prominent in the industries just yet. But with the AI revolution, keeping up with these year-to-date narratives and where the economy is looking to pivot majority of its government spending, or investors are looking to pour a lot of money into these sectors, you'll learn more and more. And that's why it's important to participate in understanding the news, listening to the news, maybe listening to Yahoo Finance every now and then, so you have this information in your head and you know what's popular or where are investors pivoting their money going into maybe 2025 or 2026 or certain quarters of the year. Another company that I like to share with you guys is Rocket Lab. This is a high risk company. You never heard of it, right? Neither have so many other people. But look at the year to date return, 180% return. That's phenomenal. Now that you're understanding low risk returns, medium risk returns, and high risk returns, it's about diversifying your portfolio evenly in between each category so you keep majority of it safe but expose a little bit of it for these substantial and increased growth potentials. So hey, if you're young, you can afford to maybe put 20% of your portfolio in high risk, and then maybe 40% of your portfolio in medium risk, and then the remaining percent of your portfolio in low risk ETFs for the long term. All depending on how much time you have and what your time horizon is on return is how you want to allocate your portfolio diversification into these different categories. So just gaining that knowledge and experiencing, hey, which companies should I be investing in, Jerry? How do I get to know which are these big name companies? Well, like I said, looking at Yahoo Finance, another great tool that I like to use is looking at the S&P 500's holdings. If you look up S&P 500 stock list, this is a list of all of the companies that are in the S&P 500. You can go ahead and research some of these companies and look at what are their revenue numbers, what are their projected growth, their earnings per share, what are their innovations, upcoming projects and partnerships. Research them, and then you're going to find some gold mines in them that honestly have insane returns and a lot of growth potential. But it's just about putting in that little work and then learning how to analyze a company to say, hey, do I agree with this business plan? Do I think this company will grow? And do I finally want to put some money in it? And also knowing what it is you can contribute. Don't put anything that you can't afford to lose in case this investment does go negative or cause you to lose a lot of capital. And that's how you start to develop yourself into, hey, do I want to play my cards safer? Let me go low risk. Then a little bit risky, medium risk. And you know how to acquire different companies into the portfolio to have that increased growth potential, but also keep majority of your assets and capital safe for the long term. And now you're playing the game somewhat correctly with some sort of structure and organization. So that's exactly how I want to share, getting into investing for all of you guys that haven't yet gotten started and want to participate in the stock market going into 2026. It's important you have that basic understanding so you know how to navigate it. Little by little, man. If it's something that you're new to, just start by putting $40 a week, maybe $100 a month, $200 a month. The younger you start and the sooner you just start contributing and making this a financial habit or just a habit for yourself, the sooner you're going to start seeing results. And then, jumping into maybe another form of investing like trading, because you already have the knowledge on which companies are volatile, popular, or maybe some of your positions are negative. And then therefore you're trying to, instead of dollar cost averaging, maybe you're playing with options to protect the share positions or make back some capital gains loss on a share position that maybe went negative. Now that you understand this, I hope this was a good video that was helpful and very informative for all of you guys looking to get started. Thank you guys for always supporting me and subscribing and liking the channel, and even just always reaching out to me through my Instagram. I hope to help as many of you guys as possible going into 2026. I hope you guys enjoyed the video. Jerry Trades with SoCal Trading Group, over and out.